The door has been open. And a stampede of bulls has charged in, sending Opendoor Technologies stock surging as part of a meme stock-style rally. The rally is fueled partly by a bull case from EMJ Capital, comparing Opendoor's potential recovery to Carvana's turnaround, and speculative bets on Reddit's Wall Street Bets, as well as short interest, about 24% of the free float, potentially sparking a short squeeze. Despite earlier plans to seek shareholder approval for a reverse stock split to maintain listing compliance, the online home flipper has flipped the script. Not too long ago, it was down 96% from its 2021 peak due to challenges in the housing market amid soaring interest rates. Now, Opendoor's supporters rally behind it because of further potential for its balance sheet to stabilize, due to factors like a strategy change, potential benefits from lower interest rates, reduced loss per transaction, and cost cuts that could lead to recovery. Earlier, Opendoor's CEO Carrie Wheeler described the agent partnership pilot as an evolution of existing agent relationships, emphasizing that the company will continue to offer both direct and agent-mediated options. Wheeler also stated that conversion improvements are the main signal for a broader rollout of the agent partnership that's meant to go from a direct-to-consumer approach towards a path that integrates agents earlier to provide sellers with more tailored advice, which could potentially drive more asset-light revenue streams. With the stock up well over 100%, despite no notable changes in the company's fundamental business yet, key fundamental catalysts will revolve around any benefits that materialize from turnaround plans. In addition to the greater adoption and improvement of its agent partnership pilot, it'll be important to observe the sustainability of cost reductions, margin improvements, and management's ability to navigate inventory mix and resale timing to maintain profitability. And of course, the evolution of the U.S. housing market will also be a critical external factor. This shifting narrative is in sharp contrast to the previously prevailing view on Wall Street, viewing Opendoor's business model as fundamentally flawed. Flipping homes at scale is seen as fundamentally flawed by Wall Street because, unlike the common comparison to Carvana's used car sales with standard models, straightforward repairs, and a well-established business model, flipping homes requires understanding local markets, zoning laws, and connections to contractors, with more friction and typically a 6% commission. Carvana had a strong sales growth track record before its collapse, and was able to lower costs and deliver steady gross profit in used car sales. Yet speculation around Opendoor looks past the adjusted net loss of $63 million in Q1 to focus on revenue of $1.15 billion, with 2,946 homes sold and homes acquired up 4% year-over-year, while fixed operating expenses were reduced by $19 million year-over-year, as well as Q2 revenue guidance expected between $1.45 and $1.525 billion. Opendoor supporters will also be looking for improved results from refined pricing algorithms for better offer accuracy and marketing spend that's been realigned for efficiency by better matching seasonal housing trends and higher spread levels.